You know, if you were to open up any standard financial app right now, you'd just see this endless stream of charts.
Oh, yeah. Just a sea of red and green.
Exactly. Green lines, red candles, moving averages just zigzagging their way across your screen.
Hmm.
And there's this very natural, almost comforting illusion that if you just stare at those lines long enough.
Right, like you're going to decode the matrix or something.
Yeah, exactly. Like if you analyze the pattern of the zigzags perfectly, you can time the exact right second to make your move. It feels really precise.
Right.
But what if those lines are completely irrelevant to the actual value of what you're buying?
That's the perfect way to frame it.
Because it's like, what if you're painstakingly analyzing the daily weather forecast, but entirely ignoring a massive shift in the global climate?
We all want to believe there's this mathematical certainty hidden in the daily price action,
Yeah.
It gives us a sense of control over an inherently uncontrollable system.
Right. Well, today we are going to completely upend how you look at those charts because we're looking at the financial landscape of April 2026, where gold and silver are just absolutely dominating the headlines.
They really are everywhere right now.
They are. Yet, despite all the massive attention, everyday investors are stepping right into a behavioral trap. They are asking all the wrong questions. So, welcome to the deep dive. Today, we're pulling from a foundational market analysis titled The Slip Up Every Gold and Silver Investor Makes.
And this analysis, it comes from Doug Young. He's a real heavyweight financial markets researcher.
Yeah, we're talking about someone with over 20 years of deep experience in the financial sector, right?
Exactly, including spending 16 years as the financial director at World Freight Services Ltd.
Plus, he's conducted over 80 gold IRA company evaluations since 2011. So the guy has seen the absolute inner workings of this industry.
He really has.
And our mission for you today is to rescue you from the most common psychological pitfall that precious metal investors fall into. We are going to decode the invisible structural forces that are actually moving these markets while, everyone else is just distracted by the noise on their screens.
Because the reality outlined in this report is that private investors are obsessively treating short-term symptoms while completely missing the long-term cure.
Okay, let's unpack this because the core mistake revolves entirely around this fixation on when to buy versus why you're buying in the first place. You go on any investing forum or social media right now, and the dominant question is always, should I buy now or should I wait for a dip?
What's fascinating here is that the underlying assumption of that retail investor is that getting the timing exactly right on a Tuesday morning will meaningfully improve their long-term outcome over the next decade.
Right, like saving 2% today is the big win.
Exactly. And by doing that, they are fundamentally misunderstanding the asset itself. They're judging gold on weekly candlestick charts and technical resistance levels, rather than treating it as a long-duration asset with very distinct economic properties.
It's like trying to time the purchase of your homeowner's insurance based on the weekly weather forecast.
Oh, that's a great way to put it.
Think about it. You don't buy fire insurance because the premiums happen to be slightly cheaper this week, or because it's currently raining outside, so a fire seems unlikely.
Right, you buy for the unexpected.
Yeah, you buy fire insurance in case your house catches fire at some point over the next 10 years.
That analogy hits the nail on the head. People turn to gold as monetary insurance. The report emphasizes that investors are actually looking to diversify their exposure away from, severe currency debasement.
Heavily leveraged financial systems.
Yes, and these massive, completely uncertain global debt trajectories.
And those aren't things that get solved over a weekend.
Not at all.
Yeah.
Those underlying drivers, like geopolitical fragmentation, central bank policy uncertainty, elevated national debt, those are slow-moving tectonic plates. They play out over years.
Yeah.
So when the price of gold drops by 2% on a Wednesday, those massive structural problems haven't magically reset or solved themselves.
But the investor looks at their app, sees the price drop slightly and thinks, the asset is weak right now.
Yeah, it's totally reactionary.
Or worse, they see the chart just going completely flat for months on end and they assume nothing is happening. But let's be real for a second. If I'm holding an asset that does nothing but go sideways for a year or two, isn't that just a bad investment?
Well,
Like, why shouldn't I just hold on to my cash and wait for a clear breakout before committing my capital?
see, that is the most common reaction, and it completely misinterprets what a sideways chart actually represents in this specific market.
How?
Well, a sideways market is very rarely a market where nothing is happening. Rather than a boring standstill, Imagine two massive tectonic plates grinding against each other beneath the surface.
Okay, I'm picturing it.
It looks perfectly still from above, but the pressure building up is immense.
So what are the two plates grinding against each other?
On the surface plate, you have short-term financial mechanics. This is the daily noise. For instance, you might see a sudden rebound in government bond yields.
Let's pause right there because financial news throws that term around constantly. Why does a rebound in bond yields push gold prices down?
It comes down to opportunity cost. A government bond pays you an interest rate just for holding it.
Right.
But physical gold, sitting in a vault somewhere, does not pay you interest. So when bond yields suddenly spike, institutional traders using computer algorithms automatically sell their gold and buy bonds to capture that yield.
So it's not even a human decision. It's just a mathematical trade for them.
Pure math. And then you add to that the selling from exchange-traded funds, or ETFs.
Oh, right.
When everyday investors get bored of gold going sideways, they sell their shares in a gold ETF. To process those sales, the fund managers physically have to sell off the gold backing those shares.
Which dumps supply onto the market and pushes the spot price lower.
Exactly. These are the short-term, event-driven forces that dominate the financial news cycle and create the illusion of a weak asset.
Okay, so that's the surface plate making all the noise. What is the plate underneath pushing against it?
The long-term structural forces. While retail investors are panicking over daily ETF flows and bond yields, the absolute whales of the financial system are quietly accumulating.
The whales.
Yes. The report highlights that central banks have been adding to their gold reserves at a historic, relentless pace across multiple regions.
But wait, I don't see massive price spikes when they buy. If a central bank is buying billions of dollars of gold, shouldn't that blow the roof off the chart?
Not if they do it carefully. I mean, they aren't logging into a brokerage app and slapping the buy button on a Tuesday morning.
Right, like a Robinhood account for a central bank.
Exactly. Central banks use over-the-counter markets. They execute steady, gradual purchase programs over months and years.
Okay.
They specifically spread their purchases out to smooth the impact on the price. They are purposely avoiding drawing attention or chasing momentum.
But why are they so hungry for it right now?
Because as global debt ratios climb and geopolitical fault lines harden, these massive institutions are reassessing the safety of their foreign exchange reserves. They're desperately seeking an asset with zero counterparty risk.
Zero counterparty risk. We really need to underline that concept.
It's huge.
That means you don't have to rely on another government or a corporation or a banking system to make good on a promise for your asset to hold its value.
That is the defining feature of physical gold. A sovereign bond is just a promise to pay you back in the future.
Right, an IOU.
Yeah, and if the government defaults or sanctions freeze the asset, that promise is worthless. Physical gold is just gold. It doesn't rely on anyone else's promise to exist.
Right.
Central banks have highly sophisticated analytical staffs whose entire job is risk management. Their behavior tells you that the most informed actors in the global system are quietly insulating their balance sheets against massive long-term risks.
So they're completely indifferent to the short-term chart. They're just vacuuming up the supply while retail investors are sitting around bored.
That quiet accumulation builds extreme pressure. When those structural long-term forces eventually overpower the short-term algorithmic noise, the price can move far more rapidly than anyone anticipated.
Here's where it gets really interesting, because a listener hearing this might think, okay, if central banks and institutional whales are quietly vacuuming up all the gold, making it harder to get, I'll just pivot and buy silver instead. I mean, it's cheaper anyway.
A very common thought process.
But the research points out that jumping into silver introduces an entirely different, incredibly tight structural trap.
It really does. Silver is a completely different beast because it lives a double life.
A double life.
Yeah, it straddles a monetary role, acting as a financial safe haven like gold, but it also has a massive, non-negotiable industrial role.
Like in tech and stuff.
Exactly. It's used in electronics, solar panels, and medical devices. Because of that dual demand, the global need for silver has consistently exceeded the readily available supply for years now. We are operating in a severe structural deficit.
But wait, if demand is outstripping supply that heavily, the math just isn't mathing for me. Why isn't the price of silver exploding right now? Why does it also get stuck in these tight ranges?
To understand that, you have to look at how silver is actually pulled out of the earth. Supply is incredibly inelastic. It doesn't respond to price the way other things do.
I like to think of it like finding an accidental prize in a cereal box.
Oh, I like where this is going.
If you really want that specific toy, you can't just call the factory and say, hey, manufacture 1 million more prizes for me.
Right, yeah.
The factory's main business is making the cereal. The toy is just an afterthought. So if people stop buying cereal, the factory shuts down, and the prizes stop coming entirely, no matter how much you personally were willing to pay for the toy.
That translates perfectly to the mining sector. The vast majority of the world's silver is not extracted from dedicated silver mines.
Really?
Yeah, it is mined as a byproduct of digging up other base metals, specifically copper, lead, and zinc.
Meaning the volume of silver hitting the market is intimately tied to the economics of entirely different industries.
Precisely. Consider a scenario where silver prices are booming because investors are terrified of inflation. You would naturally think the market would just spin up production to meet that demand.
Just dig more silver.
Right. But if, at the same exact time, the global economy is slowing down, housing construction halts, and the price of copper crashes,
Oh, I see.
a massive copper mine might be forced to suspend operations. When that copper mine shuts down, their byproduct silver output vanishes with it.
So just when financial panic makes everyone want silver, the supply actually shrinks because the industrial economy is suffering.
It creates a supply chain that simply cannot flex to accommodate sudden investor demand.
That is wild. But there is a massive elephant in the room regarding silver, and the research calls it out explicitly. We aren't just talking about physical metal coming out of a mine. We're talking about the paper market.
Ah, yes. The paper silver market is perhaps the most fragile mechanism in this entire puzzle. We're talking about futures and options contracts.
Right.
On many trading days, the sheer volume of these paper claims on silver far, far exceeds the actual amount of physical metal sitting in registered vaults ready for delivery.
Break that down for us. How does a futures contract actually work, and why doesn't buying paper silver mean I own physical silver?
Well, a futures contract is essentially a legally binding agreement to buy or sell a specific amount of silver at a specific price on a set date in the future.
Yeah.
It was originally designed to let industrial users, like an electronics manufacturer, lock in a price today for silver they will need in 6 months. It provides vital liquidity to the system.
But most people trading these contracts aren't building electronics?
No, they are speculators. And this is where the mechanism known as rolling comes in. As that future date approaches, the speculator doesn't actually want a truckload of heavy silver dumped on their driveway.
I mean, where would you even put it?
Exactly. So before the contract expires, they simply sell it and buy a new contract for the following month. They roll their position forward. They are just trading the price action, never touching the metal.
It sounds exactly like fractional reserve banking.
It's very similar.
Like the system is writing more tickets for coats than there are coats in the coat check room.
That is the exact mechanism. In normal, calm economic weather, the coat check functions perfectly smoothly because only a few people ever ask for their coat at the same time. The paper price and the physical price stay relatively aligned.
But if a blizzard hits,
If a financial blizzard hits, and suddenly a significant percentage of those paper contract holders lose faith in the system and decide they actually want physical delivery of their asset,
then what?
you have a catastrophic mismatch. The notional size of the paper trades drastically misaligns with physical availability.
It's a massive game of musical chairs, and the music is playing, but there are only 3 chairs for 100 people.
Exactly. When that structural pressure releases, paper-dominated markets can behave violently differently from what the calm, everyday charts would suggest.
So what does this all mean? We have central banks quietly hoovering up the gold supply. We have silver trapped in a structural deficit with a totally inelastic supply chain backed by a highly leveraged paper market.
Yeah, it's a lot.
If these range-bound markets are actually spring-loaded traps just waiting to snap, how do you know if you're making a smart strategic allocation or if you're just gambling that the spring is going to pop on your watch?
If we connect this to the bigger picture, it all comes down to a fundamental failure to define what game you're playing.
What do you mean?
The research stresses a vital distinction between trading gold and owning gold. When investors conflate the two, it inevitably leads to disaster.
Let's draw a hard line between them. Walk us through the mechanics of trading gold.
Trading is treating the metal like a highly volatile tech stock or a foreign currency pair. You are using tight stop losses to protect your downside. You're analyzing momentum indicators. You care deeply about moving averages and resistance levels on the chart.
Trying to catch the zigzags.
Yes. And there is nothing inherently wrong with this approach, provided it is strictly risk managed And you are honest with yourself that you are speculating.
Right.
You must accept the possibility of rapid loss if the trade goes against you.
But owning gold is a different animal entirely.
Completely different. Owning gold is treating it as a long-term asset class as the monetary insurance we discussed earlier. From this perspective, the focus completely shifts away from timing the perfect entry point and moves to portfolio resilience.
So you aren't staring at the daily chart.
No, the question isn't what will the price be next month. The question is, how much of my total wealth is currently held in assets that are not merely claims on somebody else's debt?
That brings us right back to the central banks and zero counterparty risk. You are measuring the value of the asset by how it reduces the systemic risk of your whole portfolio, not by what the chart does on a Thursday.
That shift in mindset is crucial. But human psychology actively fights against it. We hate uncertainty. The research highlights the devastating psychology of waiting.
The waiting trap.
Yeah. When the market is compressed and sideways, investors convince themselves they are being smart and disciplined. They say, let me just wait for clarity. Let me wait to see if it breaks out before I commit.
And that waiting is the ultimate trap, because clarity in global financial markets only ever arrives after a massive catalyst hits.
You don't get a warning memo. The catalyst could be a sudden inflation report that shatters economic expectations.
Or a war breaks out.
Exactly. It could be a massive monetary policy pivot from the Federal Reserve that catches everyone off guard. Or a geopolitical shock that instantly disrupts global supply chains.
And by the time that breaking news notification hits your phone, the algorithms have already reacted and the price has moved violently.
The window for careful, considered decision-making slams shut instantly. If you stubbornly waited for the situation to become clear, you are now forced into a terrible position.
You're stuck.
You either buy based on pure emotion at highly elevated, volatile levels, or you remain paralyzed on the sidelines, entirely underexposed to a structural trend you actually saw coming years ago. The emotional and financial cost of trying to outsmart the timeline is incredibly high.
It's the ultimate irony of investing. By trying to be perfectly rational and waiting for 100% confirmation, you essentially force yourself into a panicked, emotional decision.
Which brings us to the core solution presented in Doug Young's analysis, a total reframing of the investor's baseline mindset.
Okay, lay it on us.
Stop asking the impossible question, should I buy right now? And start asking the structural question, how much physical insurance should I hold based on my personal risk tolerance and my timeline?
It transforms the entire process from a stressful prediction game into a calm planning game.
Exactly.
Nobody, not even the experts, can consistently predict short-term price movements. But you can build a diversified portfolio capable of surviving a wide range of economic blizzards.
Yes.
Now, we must emphasize a heavy caveat from the research here. This is absolutely not a one-size-fits-all solution.
It cannot be. Personal finance is deeply individual.
You should never put capital into precious metals that you might need to pay your mortgage next month.
Definitely not.
It is not for short-term liquidity, and you should always consult a qualified financial professional to align these concepts with your specific age, your income bracket, and your retirement goals. It's about diligent risk management, not finding a get-rich-quick loophole.
Understanding the mechanics of the market is only half the battle. Understanding your own financial limitations is the other half. Separating short-term speculation from long-term wealth preservation is how you survive the volatility.
So we've navigated some dense territory today. We started by ditching the retail obsession with timing the exact bottom of a chart, realizing that treating monetary insurance like a day trade is just a fool's errand.
Yep.
We pulled back the curtain on the silent, massive accumulation by central banks, showing how they exploit boring, sideways charts to protect their balance sheets. And we explored the incredibly tight, inelastic supply chain of silver and how it's dangerously tethered to the fate of industrial copper mines and highly leveraged paper contracts.
It is a complex ecosystem to map out.
Okay.
But once you actually understand the structural tectonic forces grinding away beneath the surface, the daily noise of red and green candles on your phone becomes significantly less intimidating.
Before we wrap up, I want to leave you with one final provocative scenario to chew on, based entirely on the mechanics we've just unpacked.
This raises an important question regarding that paper-silver market we discussed. Imagine if a sudden, major geopolitical shift occurred tomorrow morning. A true systemic shock to the global financial plumbing.
Okay.
And suddenly, every single institution holding a futures contract decides they no longer trust the banking system to honor their paper claims.
Oh, boy.
Instead of casually rolling their contracts over to the next month, they all simultaneously demand physical delivery of their metal. What happens to a global market when the comfortable illusion of limitless paper liquidity violently collides with the hard mathematical reality of physical scarcity?
That scenario is exactly why you need to understand the hidden structure beneath the chart. If you want to dive deeper into these mechanics and explore independent, detailed market research on this exact topic, including comprehensive evaluations of the companies operating in this space, you need to visit the Gold IRA Companies Bulletin website.
It's a great resource.
Go to goldiracompaniescompared.com for a wealth of related information. That's goldiracompaniescompared.com. And just as a reminder, there's a direct link to this specific information right in the notes for this deep dive so you can find it easily.
The key takeaway is to have your insurance policy in place long before the smoke alarms start ringing.
Because at the end of the day, you really don't want to be the person standing outside your burning house, staring at your smartphone, wondering why the weather app didn't tell you to buy fire insurance yesterday. Thanks for joining us on this deep dive.